Broadcasting from Baltimore, Maryland, and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here is your host, Dan Ferris.
Hello, everybody, and welcome back to another episode of the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm the editor of Extreme Value, a value investing service published by Stansberry Research. Okay, let's get to it. Now, this week, we are going to start with something a little different, which I hope to do every week. And I call it my weekly rant. So from now on, we'll start each episode with the weekly rant, and I'll try to help investors entertain different perspectives with the rant and, try to cover a wide array of topics from, top-down market viewpoints to analysis of individual businesses and maybe even individual securities and everything in between, right? Nothing is out of bounds as long as I think I can shed some valuable and, entertaining light on the matter. Now, today's topic, the first weekly rant, might seem like a bit of social commentary, but I think you'll agree that there's clear investment implications here, and I've certainly been talking about them for about a year and a half now. And I think you'll also agree there's no way we could have ignored this event. And that event is Facebook is 15 years old this week. Current chairman and CEO Mark Zuckerberg and four of his friends at Harvard founded Facebook in his dorm room at Harvard on February 4th, 2004. Now, by all accounts, Facebook is one of the most successful institutions in human history. They continue to report 2 billion monthly active users. That makes it bigger than Islam, the religion, Islam, with a reported 1.6 billion followers. It's bigger than communism, with 1.5 billion people living under that system. It's bigger than Catholicism, with a reported 1.2 billion followers, and Hinduism, with reported 1.1 billion followers. So it's bigger than anything humans have ever done. So Facebook has gotten a lot of negative press in recent years, from studies showing social media is bad for your physical and mental health, to the scandals involving Facebook's clandestine and, I believe, unethical use of your personal data. But perhaps nobody has gotten to the heart of the matter more succinctly than a member of the UK Parliament who last year told Facebook's chief technology officer, quote, "I remain to be convinced that your company has integrity," end quote. I remain to be convinced that your company has integrity. And Zuckerberg and his top lieutenants at Facebook don't appear to understand the problems people have with the way they do business. In a recent Wall Street Journal op-ed piece, Zuckerberg wrote plainly and rather naively, when I started Facebook, quote, when I started Facebook, I wasn't trying to build a global company. I realized you could find almost anything on the internet, music, books, information, except the thing that matters most, people. So I built a service people could use to connect and learn about each other, end quote. I mean, it sounds like some kind of, there's almost like it's pastoral naivete and innocence about it. That's all we were doing. We were just connecting people. I think it's kind of a euphemistic representation of the truth, besides sounding naive. It's just not true. We all know Facebook was founded on the back of Mark Zuckerberg's previous idea called Face Mash. And Face Mash allowed users to rate the attractiveness, the physical attractiveness, hot or not, pretty, ugly, handsome, not, of fellow students at Harvard. Zuckerberg hacked the data for Face Mash, the pictures and names, stole it, apparently, from the school's records. That's the real birth of Facebook. It was born of a desire to get control of your identity without your knowledge, just removing it from your control, really. And Zuckerberg wants us to think it's all about helping you keep track of your friends and family. And yes, you can do that on Facebook. But the much bigger, more important purpose, the one that brings more than $55 billion in annual revenue in the front door of Facebook, is for you to help Facebook keep track of you. And there are tens of millions of people out there, including 87 million whose information was harvested during the 2016 election from Facebook by British political consultants Cambridge Analytica, who will have no trouble agreeing with me on this point. And as of right now, Facebook has no intention of letting anyone unlucky enough to have and regularly use a Facebook account ever to be allowed to move beyond the company's prying eyes. First of all, there's no way to get a complete report on everything Facebook knows and stores about you. There just isn't. If there was, I promise you, the outcry at what they know about you and how they categorize and exploit you would be long and loud. And if you could get such a report, and here's the really important point, would there be any way to order Facebook to totally delete that information from existence and never allow them to record and store information about you again? No way. According to a recent article in TechCrunch.com, you can't get Facebook to delete the information about you that it's gathered. Even if you delete your Facebook account, they still keep the info. Facebook seems to believe it owns your identity simply because you joined his website to keep in touch with your friends. So besides being bigger than Catholicism and other major religions and communism, it's also one of the two biggest surveillance operations in human history, second only to Google, which we'll talk about another day. So if you have a Facebook account, as things stand now, you'll never have real control over your data, which for practical purposes on the internet is you. It's your identity. Apple CEO Tim Cook had it right when he said, he was actually talking about Google, but he said, when the service is free, you're not the customer, you're the product. That's true of any free internet service that tracks your information and does something that generates revenue. And what about this mission to connect people? How's that going? Well, turns out the mission isn't really the way Facebook implies. And I'm not talking about, the teenagers who've committed suicide after being harassed online or the terrorists who've tried to influence elections through Facebook. I'm just talking about the fact that Facebook is not great for relationships, especially among young people. A 2017 Forbes article cited studies suggesting, quote, rather than enhancing well-being as frequent interactions with supportive offline social networks powerfully do, the current findings demonstrate that interacting with Facebook may predict the opposite result for young adults. It may undermine it, end quote. And we've all heard these things, right? I'm sure podcast listeners like yourself could cite at least one of the alleged harmful effects of too much social media usage. And yes, once again, I'll thank you for your patience as I trot out my own bearishness on Facebook, starting in September 2017 and continuing right up to the present. I warned stocks like Facebook and other big popular tech names like Google, Amazon, Nvidia, etc., could drop 20% or more in an instant, which of course Facebook did last July when it dropped nearly 20% after hours in seconds, obliterating $125 billion in market cap, the largest single one-day market cap loss in history. I don't think much has changed with Facebook yet, despite all the bad news and, Zuckerberg testifying in front of Congress. I think we're early days in the growing outrage over what that business really does and its true mission to harvest your data, remove it from your control, and turn it into ad dollars and other sources of revenue. Company reported 3 to 4% of users were fake, but a recent New York Times article suggests it's more like 35 or 40%. So I'm not willing to risk owning the stock here. It's probably best, I would say, to let more shoes drop, which I think will cause the stock price to continue to drop for the next year or more. And since it's a great cash-gushing business, I expect to be a buyer at some point, as long as it looks like the basic business model can hold up. But I'd rather see a new management team, among other things, and for the stock to become a true cheap bargain. So I'll discuss Facebook on future podcasts, but for now, let me leave you with the following thoughts. I just want to encourage you to get off social media for a week or two, or longer if you can do it. Read more books and long articles. Stop trying to keep abreast of everything and get deep into one very important thing. Your spouse, your kids, your career, art in real museums, music in live venues, all that stuff. Connect with real human beings, like right in front of them. That's the only way I know to really connect with other human beings. And I'm willing to bet most of those people won't be spying on you while you're talking with them. And hey, you can't get your data back, but maybe, just maybe, the less you interact with social media over time, the less accurate a picture they'll have of you and your activities, likes, dislikes, etc. I'm willing to bet the antidote to getting on social media too often is just getting a life every day. So that's the weekly rant. And, by all means, let me know if you have anything to say about Facebook, if you think I'm on the money, if you think I'm off the mark, write in, let us know. Let's look at some news items now. Interesting things going on lately. I didn't catch this one last week. eBay, right? The online auction platform. eBay is going to pay its first dividend ever to shareholders. And it'll be 14 cents a share due around March the 20th. And they decided that they would pay, they're going to pay about $5.5 billion to shareholders this year. They added $4 billion to a stock repurchase program. So, most of that is going to be share repurchases. But, I saw the news and I was like, well, why now? I mean, the thing IPO'd in like 1998, I think, and it's about a 40 to 45 bagger since then, if you've held it all that time. But it turns out that the folks at Elliott Management, this is a firm run by Paul Singer. They have about $34 billion under management. They're well-known activist investors, okay? And they have sent eBay a letter. They own, I think they own about 4% of the stock. And they've sent eBay a big, long letter. And you can actually go online. And I recommend you do this. Okay, there's a website that Elliott Management has put up. It's called enhancingebay.com. This website is really a great resource for investors because, it's got their big, long letter that they wrote to eBay. And they make these 5 points of, what they want to do with the company and how they want to break it up and how they think that there's like 75 to 100% upside within the next 2 years if the company does all these things they're suggesting. Actually, the stock's around 35, and they say they can get it up around $55 to $63 per share by the end of 2020, which would be great. That'd be incredible. And they've had plenty of success in the past. But what I recommend you do is if you ever wanted to learn something about eBay, this is your chance, like all in one place. You've got this great investor with lots of experience, just kind of laying out what the business is and what it does and how they think about it. And you'll learn a lot about eBay. That's the real goal here, as far as I'm concerned. And you'll learn a bit about Elliott Management too and how they operate. It's always good to learn how a great investor thinks and operates. So that's the first news item. Go learn something about eBay. What else do we have here? Okay. Turns out that you would expect this to happen. The CFO of Tesla has left. His name is Deepak Ahuja. And, he's left the company. And apparently, he's not the only one. They lost a couple of other folks just in the past year or so, one of whom was the head of human resources. He went away on a sabbatical and never came back. And another one, I think, was the chief operating officer, maybe, he had been there like a month or so and just was gone. And, this is it's the classic rats leaving the sinking ship. And the CFO leaving Tesla at this moment is a little rich, too, because they've got a $920 million debt payment coming up on March 1st. So, it kind of looks to me like the CFO, who's been there quite a while, sees this $920 million debt payment coming up on March 1st And the company is proposing, I think, exchanging the note for a mix of cash and stock. So maybe the CFO is looking out beyond that, or maybe he's just looking out to that debt payment or something, and he doesn't like what he sees. And I have to tell you, I met a kind of a diehard Tesla fan who had a really weird experience. He bought a Model 3 and he didn't like it and he returned it and bought a new Model S. But on his app, he was able to continue tracking the Model 3. And it's sitting somewhere in a parking lot or someplace with the trunk open. So who knows, like, what sort of precipitation might be falling into this thing, or what kind of condition it's in, and they obviously can't resell it. So, and I noticed too during the Super Bowl, I think we saw at least one commercial for electric vehicles. I think it was from Audi, and the competition is going to come out of the woodwork, and these guys are going to have real problems. And it appears, maybe the CFO just wants to get ahead of all that and skip town. So one more thing that I wanted to talk about before we get to our guest are billionaires issuing terrifying warnings. It's funny. I kind of almost hesitate to mention it, but I always want to know what the best investors have to say. And one of the billionaires I'm talking about is Seth Klarman, who put out a 22-page letter recently. And this is a guy, he's not trying to get your money. He's giving money back. So he's not trying to scare you into investing in his fund. And he's normally a pretty private guy, but he put this letter out like he's genuinely worried. And he's telling investors, for example, he says the seeds of the next major financial crisis, or the one after that, may well be found in today's sovereign debt levels. And I've been sort of sounding the warning on sovereign debt because I looked at all the negative yielding sovereign debt issues about a year and a half ago in September 2017, and I thought, they've done it again. They've taken something that's supposed to be the safest thing in the world and turned it into toxic waste, just like they did with mortgages in the 2008 crisis. And, every now and then, sovereign debt does become a problem, but it's kind of a rare thing. So for this guy to go on record like this, he must really be worried. And he says, there's no way to know how much debt is too much, but America will inevitably reach an inflection point whereupon a suddenly more skeptical debt market will refuse to continue to lend to us at rates we can afford. I don't know how that really works if we have the ability to print money to pay the coupons, but certainly, printing lots of money to pay the debt cost ain't a good thing either, and would, can lead to its own set of problems. Klarman goes on, he says, it's not hard to imagine worsening social unrest. This is a value investor. This is like, in the tradition of Warren Buffett, and this guy's talking about, it's not hard to imagine worsening social unrest among a generation that's falling behind economically and feels betrayed by a massive national debt that was incurred without any obvious benefit to them. Now, that is something that you hear a lot because, investors who focus on such things will often cite the growth in the Federal Reserve balance sheet from, I think like 800 billion or something to like 4 trillion today. And, we know where a lot of that went, just kind of into the market to ease and to make everything easier for basically what Klarman is saying most people think are rich folks. Okay. He says, by the time such a crisis hits, it will likely be too late to get our house in order. Yeah, that's the way crises work. Ray Dalio is another one, founder of the world's largest hedge fund, Bridgewater Associates. He thinks that we're headed for something worse than the Great Depression. These guys are saying this stuff with a straight face. So in Davos, Switzerland recently, Dalio said, again, like Claramy, he said the problem comes down to too much debt. And Dalio is well known as a guy who tracks debt cycles and keeps track of, long and short-term debt cycles. And he says the biggest issue is that there is only so much one can squeeze out of a debt cycle, and most countries are approaching those limits. If lowering interest rates is one of the things you do in a crisis, and rates are negative still in some of these sovereign issues, I mean, how low can you go, I guess, is a reasonable question. It's the how much ammo does the central bank have in a crisis when interest rates are really low question. And I don't know the answer. I tend not to think much about macro things. I tend to want to just prepare my portfolio and tell others to prepare theirs for bad times. And we'll actually talk a little bit about this sort of thing with our guest today. But that's what the world looks like. That's just a few news items that are going on right now. And I think it's time to get to our guest. The audio quality on our interview is not ideal today, but I think you'll agree that the interview itself is well worth listening to. So let's introduce our guest and get him on here because he's a really smart guy, and he's talked to a lot of really smart people in his life, in addition to having his own really interesting opinions on things. So let's get to him right now.
All right, it's time for our guest. His name is Grant Williams, and he is the co-founder of Real Vision Group, and he's been in the markets for more than 30 years. He's been in finance for more than 30 years. And I can't think of anybody I want to talk to more right now than you, Grant. Thanks for coming on the program.
Well, listen, you need to broaden your circle of friends now, I'm afraid, then, Dad. Thanks for having me anyway.
All right. Well, I assure you, folks, Grant is very modest, as you're about to find out. So I want to talk about a couple of things today. One of them is this series. I have to tell you, Grant, you're what I want to be if I ever grow up. You've got this series called In Conversation With on Real Vision TV, which I'm a happy subscriber to. And you've interviewed all kinds of people that I would love to talk to. I mean, you talk to them for an hour or two, and if I could get 5 minutes, I'd probably pay money to do it. Starting with Marko Hodes, who is an absolutely fascinating guy, I'd like to name a few of these folks who you've had conversations with on Real Vision, and just give me some impressions and what you learned from them. How's that sound?
That sounds great. Yeah, I'm happy to talk about these guys all day long. They've been just fabulous.
Yeah. So, what about Hodes? He strikes me as a really fascinating guy. I've never met him.
Mark is one of the most remarkable men I think I've ever met. He's a short seller, and I wanted to talk to a short seller to try and dispel this really negative impression that markets have of short sellers. We spoke about short selling and the pressures and the strains of it all and how difficult it is and the short seller's place in the market. But he brought up a company that he was engaged in a battle with. Now, to be clear, Mark doesn't short things because they're overvalued. He shorts them because he thinks they're fraudulent. And he'd just gotten sucked into this battle with a company called MyMedics. MDXG was the ticker. And, after that interview, I stayed in the story with Mark. He was keeping me informed of what was going on for the next year. And I went out and filmed a second piece with him a couple of weeks ago. Subsequently, the company has been proven it's restated its financials, said it couldn't provide financials. They fired the CEO and the CFO for cause. It's a complete disaster. So Mark is relentless. He's a crusader. His heart's absolutely in the right place, and he does the work of many men. Sadly, to deaf ears from the SEC, the DOJ, the VA, I can't think of all the other list of acronyms, FDA, who he sent incredible amounts of proof to, and they've just ignored him. So, Mark is a remarkable human being, and that first interview is actually up on the web. You can, if you just search for my name and Marko Hodes, you'll find us both up there, and it's worth watching.
So, during the Hodes interview, there's a moment when this guy who's been around for a long time and shorted all kinds of stuff looks at you with a straight face and says, "I've never seen anything like this."
Yeah.
That blew me away. That blew me away.
You know, Dan, that to me is symptomatic of the world that we've built around ourselves over the last decade. You know, to me, I feel the same way about Tesla. I've never seen anything like it. You know, never seen anything like it, and that has yet to play out. Mark was talking about this as the biggest fraud he'd ever seen, and he's shown me the proof he's got. I mean, it stands 3 feet high. The proof, and if you haven't seen the story or read the story, it's worth looking at, because you'll find a trail of events that beg a belief, and the fact that it could go on for so long, given all the proof that's out there, is remarkable. But as I say, I think it's symptomatic of the world we live in.
I couldn't hardly have said it better myself. Another guy that you spoke with, who I would love to talk with, is Hugh Hendry. For our listeners, Hugh Hendry, formerly of Eclectica Asset Management. He closed Eclectica up a while ago. And what did you... I didn't get a chance to look at 1 minute of this particular interview. What do you talk about with a guy who's... I mean, is he retired?
Hugh is someone I've always been fascinated with. You know, he's a lovely guy. He's incredibly smart. He just thinks differently to other people. He just has this amazing brain that thinks in a way that I wish I was capable of. And I wanted to go and talk to Hugh because he had just closed Eclectica, and I wanted to talk to him about his story as a hedge fund manager. You know, the rise and fall of a hedge fund manager, and the rise and fall of a fund. As a kind of proxy for the hedge fund industry as a whole. You know, we saw hedge funds become the stars of the finance industry through, you know, late mid 2000s, and then kind of the last 7 or 8 years they've been in decline. It has Hugh's own career by his own admission, and to have him tell that story and really be candid with me and talk about the pain and the pressure of doing it. I mean, he's again a remarkable guy, fantastic company, brilliantly smart, searingly honest. And just to hear someone who's been at the very top of that business and then ended up closing his fund talk about that journey and the highs and the lows and the kind of demons you have to wrestle with, it was eye-opening for me, and couldn't have been more candid. He couldn't have been more generous with his time, and I think about it often still. And Hugh and I are in touch, and I think about him often, and I hope that you know, he's now at peace and looking for perhaps the next thing to do, whether it's back in the finance industry or not, I don't know. But what I do know is whatever he decides to do, he will be good at it, because he's a remarkable guy. He
is. And, you know, one of the things, I did see an earlier interview that you did with him. He said a lot, or he gave a general impression of, you know, what happened to his particular bailiwick, which is global macro. And it sounded, you know, if I had just sort of bleeped out the words global macro, I feel like as a value investor, I could have inserted the words value investing. And it's all the same complaint. And, you know, it just struck me, you know, the chain goes all the way out. It goes, you know, global macro, value, similar problems. You know, they've underperformed for, you know, since they performed like gangbusters. You know, they've underperformed for the past decade. After having done really well, and really it's kind of like the whole active space, I think, you know, is what we wind up talking about. But those two areas in particular, global macro and value, and you know, I think of you as a global macro guy, and I'm a value guy, so I don't know, sort of sitting here lamenting to one another. Another guy you talked to who I'd love to meet, just because he is kind of a legend, is Leon Cooperman.
Yeah.
Yeah, you had a great conversation with him. What was that like? What's it like? What is he like?
Well, look, he was introduced to me by a mutual friend of ours, and he said, look, you know, Leon's got a heart of gold. He said he can be a bit gruff, but he's got a heart of gold. So, you know, call him up and you know, tell him what you want to do, and it'll be fine. So I called him up, and you know, had this gruff voice answer the phone. Sure enough, and you know, very short. You know, yep. Who are you? What's this about? Yep. Okay, fine. Yep. Fine. Speak to my assistant. So we hooked this thing up, and I you know, I was a little bit nervous, to be honest, going down there. Because as you say, he is a legend, and you know he's widely known as the hardest working man on Wall Street. So I know he hasn't got a lot of time. But when we got down to his home in Florida, he could not have been nicer. He was an absolute sweetheart, and he gave us time, and he was open, and he was honest, and he shared his story. And you know, this series was all about just sitting down with people and getting them to tell their stories, because you know I'm a great believer, and I follow this in things that make you go home. The letter I write, I'm a great believer that we as human beings, we connect through stories. You know, stories are how we pass on ideas. They're how we predict the future. They're so important, and the art of storytelling is kind of been lost to a large extent, because people don't have the time to listen to stories anymore. They just want sound bites, and they just want stock tips. So I wanted to sit down with these guys, get them to tell their stories, and try and learn lessons from their successes and their failures. And you know, people don't talk about failure enough. And you've got a lot of successful people who, whatever failures they've had, they've got past them. They've fixed them. They've moved on. And for the most part, they're happy to talk about that, because they are a success. They know that their failure didn't break them. It was a temporary thing. And so I just believe that we can learn so much from other people's mistakes, and more importantly, how they cope with them. And so that's what I try and do in these conversations. It's just talk to people about their lives and their careers, and some of the things they got right and some of the things they got wrong. And hopefully the people watching take something away from that and can either avoid making mistakes of their own that are similar to those they've heard about, or incorporate, you know, very successful investors' process into their own framework.
Yeah, boy, more people need to talk about their mistakes. This is one of my gigantic complaints with, you know, run-of-the-mill finance TV is they're bullish on Monday and bearish on Tuesday, and on Wednesday they forgot, you know, the last 2 days, and they never go back and talk about anything they got wrong. It's kind of one of the things I'm trying to change by doing the podcast here. So anyway, do you have a favorite? You know, you can start with Cooperman. Do you have a favorite Cooperman story?
Well, do you know what? It was listening to him talk about his days in the business, and you know, the early days in the business when he just got into Goldman Sachs, and he was setting up Goldman Sachs Asset Management, and you know, he wanted to start a hedge fund, and the company said, no, you know, that's not the business we're in. We don't want to do that. So just to hear, you know, what was a young guy then have the guts to say, you know what, that's right, I'll walk away and do it myself. You know, it's those kind of decisions that when you're confident in your ability, and you're confident in your business, and you're confident in what you think you can achieve, having the guts to take a leap and do it is a hard thing. It's a hard thing to do. You know, Lee had already had some success, but nothing like the success he had with the subsequent business he founded, which was, of course, Omega Advisors.
Right. So did he talk about did he talk about the last few years, underperformance of value, et cetera?
Yeah, I mean, we spoke about that, and he's at the point now where he's gonna close his fund down and run family money for all of these above reasons. I mean, if you're a value guy, you know that value just hasn't worked, and if you think about that statement for a while, how can value not work? Value is value. It is, that's what it is. And so for value investing strategies to not work, something isn't right. You know, he's kind of fed up with that and wants to be able to manage his own money in a way that he's more comfortable with, which is with a longer term view, without being chased up and down, without, I guess, having clients, you know, calling up at the end of a month and saying, hey, you know, we missed the S&P benchmark by 15 basis points. What went wrong? Nothing went wrong. We missed it by 15 basis points. It happens. But everyone's so short term nowadays and chasing returns that a lot of money managers, not just Lee, but a lot of money managers I've spoken to, you know, seasoned guys who've been around for a long time, have just had enough. They've had enough of short termism. They've had enough of being judged day to day. And a lot of them are either raising lockup capital for 3, 5, some of them 10 years in a private equity type structure, or they're not taking any more investment. And I totally understand why.
Yeah. Yeah. You did talk with Rick Rule, at some point. I saw a video you did with him, and he's been locking people up for 10 years for a long time.
Yeah,
he's way ahead of that curve.
But I think in his chosen part of the world, the commodity space, if you ever think about the 10 years it takes to get a project online, it makes a lot more sense. And I think people will understand, if you're going to be in the mining space, why you would need that lockup capital. But I spoke to another investor and a dear friend called Tony Deeden, who lives out in Switzerland. And nobody's ever heard of Tony, and that's just the way he likes it. He'd hate me for talking about him now, but he's a remarkable guy and a remarkable investor, and he buys stakes in companies that have been in business for 100, 150, 200 years, and his time preference is infinite. He's not interested in daily movements of markets. He wants to buy good companies that have a proven track record and do good things very, very well. He doesn't pay an undue amount of attention to PEs and EBITDAs. He wants a good business run by good people. But he's very particular about the people that run the companies and the companies themselves. He told me a great story. He had a position in a company called Sadia, which was Brazil's biggest chicken farmer and was a big global supplier of chickens. And he said it was an extraordinary good business, really good business. They just farmed chickens and sent the meat all around the world. And he went to see the company, and the CEO was away. He spoke to the CFO, who said, if only we could find a bank to work with. We think we can foresee the foreign exchange markets, and we'd be able to increase our profits because we'd be able to hedge our currency exposure from all the chickens we sell overseas. And Tony thought this was a strange thing, and he made a note of it. And 2 years later, he saw a headline come across the tape that this company, Sadia, had bought 60% stake in a Brazilian bank. This was 2 years after he had that meeting, and this guy had said that one sentence to him. And Tony said within 30 minutes, he'd sold his entire stake in the company. And within 2 years, the company was bankrupt, out of business. And it's remarkable that he would do that, because Tony buys companies to own forever, essentially. If they're good companies doing good things, he'll own them forever. But if they change, if they're starting to do things that weren't the reason he bought the company, or they're doing things that you shouldn't be doing if you're a chicken farmer, then the whole thing gone in 30 minutes. It's remarkable. And so to hear those stories about how great investors think, about how they invest their money, about how they manage those positions after they've gotten into them, is just a real privilege for me to have the time to spend with these guys. Nice story. Well, that interview is also up. We put that up in full. It's this is a 2.5 hour interview. I mean, think about that in this day and age. Who wants to sit and watch 2.5 hours of interviews? I've had people stop me in the street all over the world to talk about that interview, and people who've watched it multiple times because of all the wisdom in there. And so if you just Google my name and Tony Deeden, Deden, you can find that interview up there. And if people are really interested in value investing and just wisdom, this is a remarkable conversation with a remarkable man. Yeah, long form anything is frequently a tough sell, and frankly, it's more valuable by comparison today. Just the ability to turn off the internet and read a book instead of reading a bunch of little snippets. Yeah. And to sit through an interview like that, it's like listening to Beethoven's Ninth or something, which hardly anybody does anymore. That's a great analogy, because it's you talk about sitting through it. I mean, no one I've spoken to felt like they were sitting through it. They were sitting there, and at the end of it, they were kind of upset that it had finished. It's that kind of conversation, and it's nothing revolutionary. He's not reinventing the wheel, but to hear someone talk about principles and scarcity and permanence and all these core values of humanity, which has sadly been lost in the modern day and age as we've chased instant gratification, it's a real wake-up call for a lot of people. And I was talking about it to a guy yesterday. We had a small conference here in New York, and without any exaggeration, this guy actually started to cry as he talked about this interview and the effect that it had on him and his wife and their business, and how they wanted to leave their business to their children, and some of the things Tony had said. I mean, it's amazing how powerful real intelligence and real wisdom can be in a world where we are so filled with information and so lacking in knowledge.
Well put, Grant, as usual. So, look, there's a lot of folks. So I could sit here and go through a list of, probably 10 more names. But, I'm not going to have Grant Williams on the program without asking him what he thinks about what's going on in the world. And I was looking on Real Vision, and I saw a piece that you did, I think it was like 2 or 3 years ago, and you put up a bunch of charts and kind of described the macro environment. But, of course, with the unpleasantness of late 2018 just behind us, I want to know what everybody's thinking. I want to know what's on everybody's mind right now. So, what do you think? Do you think, for example, in U.S. stocks, was that the beginning of the end? Is that the beginning of the bear market?
Well, look, it certainly felt like it at the time, and I think people who aren't really up to their waist in the markets probably don't have a true appreciation of the kind of level of disruption and panic we saw in December. It was pretty brutal, actually. It only lasted a short period of time, and things have stabilized. And clearly, the Fed saw something for Powell to flip flop like he did. So I think that was the beginning of the end, but that's not to say the end plays out in linear fashion. That could be the beginning of the end, and now we have a battle between the Fed trying to assure everybody that liquidity is going to be maintained and rate hikes are off the table and QT may be put on pause and everything they need to do to try and not scare the horses. But the simple truth is, after a 10-plus year expansion, the US is heading into a recession. Now, I don't know when that's going to happen. I'm surprised it hasn't happened already, and I suspect if we get through 2019 without it happening, we'll find out in 2020 it happened, because obviously these things are always backward looking. And that's the point where it doesn't really matter what the Fed do. It doesn't really matter what these guys say. That's the point in the business cycle where reality is returned to the forefront. And to me, everywhere you look around you, that reality is difficult to see. When you look at some of the levels that we're trading at, you look at some of the build-up in credit and debt instruments around the world is just remarkable. And so, I think people sitting at home who are listening to this, perhaps it's and this is another thing I talked to one of my guests on the In Conversation series with. Stress test your portfolio. You don't have to believe there's a recession coming. You don't have to believe there's a stock market crash coming. But at least now you've seen what happened in December. Now you can see how quickly things can get really ugly. Stress test your portfolio. And if you couldn't stand another recessionary environment, think about lightening up on your portfolio. If you're positioned well, great. But don't just sit there and kind of hope everything's going to be okay and hope that someone else fixes it for you, whether it's the Fed or somebody else comes in and rescues the markets. Have an understanding of what an economic downturn would mean for your portfolio, and also do it in dollar terms. My friend David Hay talked about this in our conversation. Do it in dollar terms. It's fine to say, I could weather a 30% downfall. But if that 30% is, I don't know, $700,000 of real money, as David said, when you do that, you see the blood drain out of people's faces. So be realistic about this. Be realistic, be prepared, and just at least understand what your potential risk is, and then decide for yourself. If you think the people who are calling for a recession or calling for the market to go down are talking nonsense, okay, fine. We're all guessing about the future. None of us know anything, right? We're all trying to take our best guess. But if it would hurt you beyond pain that you could just kind of shrug off, then you need to do something about it. To me, it's that simple.
So when you say stress test, are you saying take a look at how ugly it got in December and ask yourself if you can go through that again? Or are you just looking at individual positions?
We'll take a look at December. I mean, we've had this position between October and December, I think, last year, or September and December last year. You've got a period there where you had some real volatility for the first time in a decade, essentially. And you can see what your portfolio did. Now, at the time in December, everybody was panicking. Now things have stabilized. Don't just kind of sit there and think, well, hopefully we get back to those highs again. Take a look at the damage that was done. You've reclawed some of it back between then and now, which is great. But take a look at the damage that was done and realize not only has that happened, but it can happen again. Now, if it happens again, can you rely on the markets bouncing? I don't know. I don't know. I suspect not, but that's an individual decision for people to make. But to not look at it and then make the calculation rather than just breathe a sigh of relief that everything seems to be back to normal again. I just think it's a very short-sighted approach to managing your money.
Yeah. Did you hear that, everybody? I couldn't have said it better. Ever since 2008 or 2009, back then we found out that all kinds of stuff correlates when things get bad enough, right? Everybody said this or that asset didn't correlate, but people sell what they can sell when the excrement is really hitting the fan. So, besides cash, maybe some gold. I mean, I've been telling people to hold plenty of cash for about a year and a half now, and some gold too every now and then I mention. But what else is there?
Well, look, it depends. I mean, people would tell you that you should be looking at high quality bonds. Everybody's different, and this is one of the big problems, is that everybody wants a cookie cutter response, a cookie cutter idea of what they should do. People get fixated in profits and numbers. The simple truth is, a lot of us, we're asking people we've never met to give us their best guess about the future, and to blindly follow that is, if you do that, it's on you. Because if you ask me to guess what the weather's going to be like tomorrow, and I tell you it's going to be sunny, and you go outside without an umbrella and get rained on, it's not my fault, right? I mean, you asked me what I thought, I told you. And I may have looked at all kinds of proprietary little models that I had to predict the weather. It wasn't anything on my part that was designed to be a bad outcome for you. You asked me for my opinion, I gave it to you. And that's one of the problems we have today is there are so many people who want advice. There are so many people willing to give them advice. But ownership of this ultimately has to come down to the people making the decisions. And so take the time, weigh up the opinions, but don't just take them as read. If you like it, if you hear an opinion on what may be about to happen that appeals to you, that's the first step. That's not the end of it. At that point, okay, start checking. Are there other people saying the same thing? Are they as credible? Find someone that disagrees with it, and then hear the counter case, and then weigh up your options. But to kind of say, well, I'm going to be 85% in stocks and 15% in bonds because I saw a guy on CNBC say that was the way to be. It's just dereliction of duty, I think. I
want to transcribe that and print it in every newsletter I publish for the rest of my life.
Right. Well, you can claim it as your own.
Yeah. I mean, every now and then you try to tell people that, but, if you're the guy who said, he thought XYZ stock was a good bet, I mean, they'll just never let you live it down. But I'm gonna write something like that in my next issue.
Yeah, I do. I think it's important. I really do think it's important that people understand this. And I just think, as I said to you earlier on, with all this information, it's hard to find the knowledge, and the knowledge, as I said, has to be the start of the journey, not the end of it. It's somewhere you begin, and then something you just build up over time.
Well, people are impatient to begin with, and then when you hit the human brain with the 24/7 news cycle that we have today, yeah, and mobile devices and all the rest of it, it's just like a recipe for making the worst possible decision about the most important things in your life, your health and your money, etc.
That's exactly right, Dan. It's exactly right, and it's a shame, and it's a real problem. And I think the same way you do at Real Vision, that's what we've set out to try and do, is just try and give people the tools and the ability to listen to people who aren't necessarily giving them investment advice, but they're just talking about their own investment careers. And it's the old teach a man to fish allegory, right? I mean, you give a man a fish, you feed him for a day. You teach a man to fish, you'll feed him for the rest of his life. And that's the simple truth. A stock tip in isolation could be a winner, could be a loser. It may go up. You may make some money out of it. But real investment wisdom, real experience, real knowledge, and understanding success and failure, that's something you can apply to every stock you buy for the rest of your life.
Right. I heard something, Grant, that makes me think of you guys from now and then at Real Vision. So I forget who it was that said this. He said most people, I think it was something I saw on Twitter actually. He said most people want to know about track record first, and then they want to know a little bit about process, and then they'll be patient about listening to your philosophy, and then they want to know about the people. And what you should really do is prioritize it exactly the opposite. You should learn about the people, their philosophy, their process, and then look at what they've actually done with all of that.
You know, Dan, that is so true. And when I talk to allocators, and I was down in Florida last week, and I talked to some big time investors, and they all said the same thing. You know, you bet the jockey. You bet the jockey, and find out about the people, because look, as I said, we're all guessing. We're all guessing. The finest money managers on planet Earth are guessing about the future. It's their experience and their successes and failures that enable them to make a better, more educated guess than the rest of us. But without understanding those people and without knowing their stories and knowing how they've accumulated that experience, you're not really going to know. And so to try and understand the people you're giving your money to, are they principled? Have they bounced back from failures? Anyone in this business can theoretically have a gangbusters year. You know, your returns could be amazing this year. But if you look under it, they may have got one hot internet stock that went up 10x and distorted the returns. Can they do it over the cycle? Well, you have to wait and see. But it's a painful lesson to learn if they can't.
Yeah, you need to know. That's right. To pick, a manager or a fund or even a company, you have to get an idea of how the people involved are going to behave full cycle, right?
Yeah.
Yeah. I have a couple of stocks in the portfolio, my newsletter, where I'm in for the long haul. There are no we're not going to sell if the thing is down 40% or anything like that, because I know the people and I'm confident of how they're going to behave over time. Listen, Grant, we've actually run out of time already, if you can believe that.
Well, I can. Time flies when you're having fun, Dan.
Yeah. So, I can't remember. I think I spoke to you once briefly 2 years ago when I was having a drink with Tim Price in Las Vegas. I hope it's not another 2 years. So we'll have to make a point of not waiting 2 years, I guess.
That would be great. I'd love that.
All right, Grant. Thanks so much, and hopefully we'll talk to you real soon.
Dan, you're welcome. Thanks for having me.
All right, now it's time for the mailbag. And remember, your feedback is important to the success of our show. You can simply email us with a question or a comment at feedback@investorhour.com. We read them all, and we try to respond to every single one. Okay, we have two of them today, and here's the first one. It's real short, but it's real sweet. It says, "Great work, Dan. Loved the info on gold. Been looking for this." So just so you know what he's talking about here, and it's anonymous. It's just, there's no signature. That's all we got was this one-line email. And the info in gold that he's talking about was our interview with Fraser Buchan last week, Fraser Buchan of Tradewin Markets. And I won't give it away, actually. Just listen to that episode if you haven't already, and tell me that that's not the best way you've ever heard of to buy and sell physical gold and to own physical gold. And I'll leave it at that. But thank you, Anonymous, for your email. We have one more. It says, "Hey, Dan, I like the Investor Hour with you hosting. Over the past few weeks, I heard you say many times that the market a few weeks ago was the most expensive in history. Now, I think expensive is relative. Just because the market was at its highest levels doesn't mean it's most expensive. Based on which metric was it the most expensive in history? if Walmart sold apples for 99 cents a pound for the past 50 years and sells it now for a 5-pound bag for $3, it's not the most expensive apples ever sold. I'm not quite sure about that example. And then he just finishes up by saying, it might cost the most, but it actually is less expensive. I'm sure you get where I'm going. Thanks so much in advance. Jacob H. Okay, Jacob, you're right. I'm not talking about the market hitting new highs. I'm talking about 5 metrics that are tracked and followed by a guy named John Hussman at HussmanFunds.com. And they're things like price to sales and cyclically adjusted PE ratio, adjusted also for margins, and a couple other things. And you put these 5 things together, and Hussman reported that they hit their all-time highest level the last week of August. And then he put that report out in early September. But then, of course, in September, later that month, we went on to hit a new all-time high. And I know the data didn't change that much, so I'm saying that all-time high in September, around 2930 on the S&P 500, was the most expensive moment in history. In terms of valuation, not just the highest price, in terms of the valuation. And you can see this. The easiest one of these things to look at is price to sales of the S&P 500. So the all-time high just in that one metric, price to sales, that was actually back in January. Okay? But anytime it's above 2 times sales, it's really expensive. And it's never been above 2 times sales without like crashing shortly thereafter. Okay? And, you know, it hit 2.24 at the top of the dot-com boom, and it hit 2.36 actually just about a year ago. Yeah, just about a year ago. So, you know, then, of course, 2018 turned into the worst year for stocks since 2008. So that's what I'm talking about. Talking about valuation, not price, and you're exactly right. Highest price doesn't mean most expensive valuation. Good question. Glad you asked it. And that is it for the mailbag this week. And that concludes another episode of Stansberry Investor Hour. So be sure to check out the revamped website, and you can listen to all the episodes there and get transcripts of the shows. And you can enter your email to make sure you get all the latest updates. Just go to that same address, www.investorhour.com. That's it for this week, folks. We'll see you next week.
Thank you for listening to the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email at feedback@investorhour.com. This broadcast is provided for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.